Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Hello, today we're going to talk about common option trading mistakes that beginning option traders make. Another common mistake that beginning option traders make is not understanding the leverage that an option contract brings to the marketplace. So now let's talk about the leverage factor, and let's talk about the most basic option strategy that is out there. Let's just talk about buying a call option. This call option is going to give us the right to call stock away at a specified price that we're going to reference as the strike price for a limited time period. We're going to look at two different scenarios. We're going to talk about Peter, we're going to talk about Linda. And so in this instance, Peter finds out about option trading, gets all excited about it, goes out and notices that, well, the stock's trading at 60. If I buy 100 shares of stock, that would be $6,000. Peter then notices that the call option, the 60 strike call option, is trading for $3, and that call option represents 100 shares, so we're talking about $300 for one call option. Well, with that $6,000, Peter quickly notices that, oh yes, I can buy 20 contracts, and 20 times 100 times 3 also equals $6,000, and hence I can spend my entire lot on these option contracts. All right, now let's talk a little bit about Linda. Linda has the same amount of money in her account. She has $6,000, normally buys 100 shares of stock. If she thinks the stock's going to go up or if she's bullish on the marketplace, that's what she would do. She realizes in option trading, I can actually limit risk by buying that option. So normally buys 100 shares of stock. Guess what Linda does? She buys one of the at the money 60 strike call option and spends $300 of her $6,000. So there's a lot of difference between what Peter and Linda are doing with the options. Linda now has limited her risk to that $300. Peter has increased his risk and now has a decaying asset where he could lose his entire investment if the stock doesn't go anywhere over the life of the option contract. So how can we trade smarter? Well, if we're looking at the general rule with beginning option traders should be that if you usually trade 100 shares of stock, you should start out by buying one option contract. The capital involved in buying one option contract is going to be your total risk on that option trade. So when I'm looking at buying one contract, I just want to talk about the percentage gain if I'm correct on my forecast. So bottom line is start small. Start with a little bit of capital. Could you buy two option contracts? Yes, but ease your way into it and get a handle of the leverage factor that's involved in option trading. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.